Hey guys, we're live with George Coyle again. So excited to talk to George again. And this has been coming up lately, which is talking about William O'Neill and the can slim method and so on of stock picking and stock trading. So this keeps coming up for me over and over again. And I was thinking today, I was like, man, George is a great one to talk to about this. So just basically going over the market, the month performance, the Russell 2000s obviously leading the way. We've seen a massive rotation in the market lately from this very thin market to breadth kind of widening out. Yes, it's pulled back the last couple days, very normal. Not to mention very normal in an options expiration week, especially in July. You see a lot of weakness in July in that option expiration week, and usually we see a nice rally into the end of the month. We'll see if that holds up. The seasonality isn't 100%. Things can happen. But we'll see if that holds up and see if the Russell 2000, industrials, energy, and so on, these leading sectors that have been leading the way lately, can continue. Behind that, we have coffee up 6%. And year to date, the winner is still cocoa. I don't think that's going to come off. I think cocoa could come down another 90%, and it would still be the leader year to date. Cocoa up 192% for the year. Orange juice behind that up 37%, coffee behind that up 31%, and silver behind that up 21%. The precious metals, they're just trending. Gold made a new high recently, so that's held. So we're still seeing gold up around 24.68. So gold continues to hold up. A lot of things have been moving lately, and if we go to the industry groups, you see the 1 week performance, real estate's leading the way, financials behind that, energy behind that, and industrials. So if we're looking at the 1 week performance, we're seeing some of these lagging sectors start to lead the way again. So that's kind of cool to see. Same with the 1 month performance. We're seeing real estate, financials, energy, industrials. I mean, that's a much different look than the late 1 month performance, which has just been technology over and over again. So it's kind of interesting. So also today, we got George on here. So if you guys have questions for George, please jump in the chat. If you're on YouTube, especially, I know everybody's on Twitter usually to watch this. So, but if you're on YouTube, please jump in the chat, ask George some questions. He has lots more answers than most people do. So George, getting right into it. Let's talk about the idea of the can slim method, the idea of William O'Neill. Can you just give a kind of a basic overview of what it is?
I don't remember what every letter stands for anymore, but
I'll pull it up.
Okay. I guess Bill O'Neill came up with this method to screen down stocks and identify what he thought would be, I guess, super performers is the way I'll put it. You guys will have to forgive me. My voice is a little loud today. But yes, thanks. It was a screening method. And O'Neill's an interesting guy. I guess he was a broker, right? And he found a lot of ways not to make money. And he started to study Jack Dreyfus, who actually was a guy who hired Druckenmiller at one point to work for him. And they have a similar philosophy. And I think it was Market Wizards, just to kind of go back on O'Neill, where he said that he studied Dreyfus because they had the best performing mutual fund for 10 years. And he said not one, not a few, but every single stock that Dreyfus bought was very near a new high. And so he learned that buying new highs was the way to do it. And then O'Neill went down this path where he really studied, what attributes certain stocks had that were super performing stocks that could kind of go to the moon. And he ended up personally making a lot of money in a few, I think it was like 3 stocks. One was Corvette with a K. Chrysler might have been one. I forget what the other one was. But that got him basically a stake, which is a quick side note, interesting. Like most people wind up with a stake somehow that enables them to go pursue their dreams. And let's come back to that in a little bit. But he started a newspaper in Investors Business Daily, and he also managed money behind the scenes. And I think he did it publicly a bit, but it's not as talked about and it's not as prevalent today as IBD. I'm sure there's people that know more than I do about it. But anyway, so he came up with this can slim method that was basically how he filtered down and found the stocks that he thought would be the super performers. And then he would subject these to various technical patterns, which he goes through in his how to make money in stocks, or what's the name of his book? Is it How to Trade Stocks, How to Make Money in Stocks? A lot of these books have the same name, so either way, like it's something like that. But yeah, and then interestingly, like Investors Business Daily has IBD 50, which is basically a filtering mechanism to identify stocks to this day that have the attributes of CanSlim. So, to me, that's kind of like the backstory on him and how he did stuff. It's interesting too, though, because when he talks about trading, he says in his book, you shouldn't have any more than a handful of positions. If you've got a small account, 2 or 3, and if you've got a big account, maybe like 5 to 8, which is a bit different from what most people say and think. And we talked last week a little bit about concentration. But anyway, so that's sort of like his method of screening for stocks. And then he trades them. He looks for setups. He had a handful that he describes. His kind of most known one is like the broken teacup with a teacup with a broken handle. So it's like an up chart that pulls back, that breaks out, which is interestingly similar to what Livermore said. Like he'd buy a new high after a normal reaction, normal, subjective. But he had a lot of success with it and got a big following. And personally, I think if there's like a one-stop shop to kind of learn in the stocks on the long side, a method, how to trade, where to cut your losses, where to take profits. I'm not a big believer in that, but he liked to do it on some of his stocks. He probably has the best like A to Z robust solution, because you can read the CanSlim stuff and there's some subjectivity to it. He talks about, what's new, and that's subjective, right? How do we define new? But that said, you can subscribe to IBD, and I don't make any money saying all this, by the way, just so you know. But you can look at their 50 stocks or their different lists, and you can screen for stocks that have those attributes. Then you can read his book about how to trade and try to align with what he did. So, I'm a big fan of, I guess, his work. That said, I guess the thing that I see is a lot of guys, he's got a lot of disciples, and in academic research, most people will cite certain papers, right? Everything kind of goes back to a paper and then goes back from there. So there's Fama French, if I'm pronouncing their names right, is a paper in the equity markets that people talk about. O'Neill is similarly like a guy where a lot of modern stock traders go back and trace back to him, and he goes to Dreyfus, who goes to Darvis, who goes to Livermore. But most of the guys today that follow his methods, what's interesting is they've had kind of 2 windows of super performance. And if you read their books, literally, most of them are written about the late 1990s, which was obviously the tech boom. The other period where I've seen those guys do really well, or saw them do well, was 2020, which was, Fed stimulus coming out of COVID. So I think the method works over time, but I think like every method, there are time periods where it's just amazing and other time periods where it doesn't work as well, as evidenced by the volume of books written. Because look, if you had made, I don't know, 10,000% or whatever some of these books talk about in 2020, why wouldn't you talk about that as opposed to 1999, right? You would write the book about that era. The other thing that I guess I wonder is, excuse me, I don't really see anyone managing money in a professional, large way with that method. So, and maybe they're out there. I mean, if there are, please comment or let me know. But I guess I think the method works, but I don't think it scales in a way to manage 100 million, 200 million, plus dollars and build a business around it. So I think it's like, if you're trading for yourself, if you're running a little bit of money, there's a lot of good stuff that can be learned there. What he says adheres to the principles. He studied the greats before him. A lot of people who've come after have done similarly well, but there's certain windows where it's just amazing, and then windows where it obviously isn't, as evidenced by people talking about the results. And then the fact that there's no dedicated money manager who's saying, I'm using Bill O'Neill's trading method of 5 stocks or whatever, I think says a lot, because if it did work and it scaled, wouldn't somebody be doing it, right? So anyway, that's probably a good overview.
Yeah, and I brought up the CanSlim method just so everybody knows what it means. Current quarterly earnings per share, then annual earnings, then new products, scarce supply, leader stocks. So basically looking at relative strength, institutional investors, and then market direction. So looking at trends. So yeah, I mean, I think it's right, and I think that it's something that I try to talk about a lot, which is there's a big difference between when you're looking at the market and going, hey, I'm an individual trader, this is what I do, I'm a retail trader, and then you're running money. Um, let's be honest, nobody wants you to run. Like if I'm in 5 stocks and I pick 5 stocks only, and my drawdowns are 40%, 50%, most people aren't going to allocate any money to me. They're not going to want to sit through those. They're going to think that's ridiculous. It's just how it is. But an individual investor, like if you talk to them about them running their own money, and this is probably a fallacy in trading, is where people think if I'm running my own money, I can handle anything and it doesn't even matter. And that usually lends to really bad decision making at times. So I do think, like you said, there's a way to take what's in here and add it into a method that would be applicable to a fund. And you would probably diversify a bit more, probably do, smaller position sizing, probably other things. And that might be smarter even for the average retail investor too. But if you're looking for those crazy returns that they talk about, these 10,000% returns, which are, very, very rare, you're going to really have to be very concentrated and handle those massive drawdowns and possibly blow up many times over. So I think that's a good overview of that and what we're talking about here today. But I really
Can I jump in for a second? Just a couple things. Like most of the stuff that you hear anywhere about Bill O'Neill is just great. It's like, here's a guy who had no haters. Oh, there's one guy on Twitter now who worked for him, and he kind of is he points out some negative things, but for the most part, everybody Bill was the greatest thing that ever was. But what doesn't get talked about much, and I can't even remember where I read it, but there were periods where he was down 50%, to your point, on his own trading. So it's certainly, I think one of the things that we collectively do, and I wrote some post about this a couple months ago, but it's like the market legend bias. We focus on this window where they absolutely killed it, and then we kind of ignore what was before or after to get there. Whereas, to your point, in the case of Bill, he did have difficult periods. A couple other things. There is some RIA, I forget their name, but in Connecticut, that uses something like his method, but they don't do it. They're not discretionarily trading 5 stocks. As I recall from reading their ADV, they're kind of like using the can slim method to build a larger portfolio. So, yeah, anyway, just wanted to chime in with those 2 points.
No, it's interesting because I didn't know that. That, and that's the only way I could see that working, just because, especially like I'm a futures trader, seeing if I was like, you know what, I'm only going to trade oil, gold, the S&P 500, and 2 other things, there'd be some massive drawdowns. There'd be some massive problems. You'd run into extreme underperformance periods. However, you would run into extreme outperformance periods, to be correct on that statement. But looking at it, I think it's what's interesting here is, and something you and I have talked about before off camera, which is when we're talking about these things, what's the right environment that you're thinking of that would make sense for this type of a method to be those 10,000% returns?
I mean, I guess like, what's the Goldilocks scenario for stocks? The multiples, PE ratios are very low, so everybody's like, stocks are the place to be. That would be one factor. 2 would be the Fed has created a bunch of acronyms to flood the system with liquidity. Interest rates are 0. That's a big thing I think a lot about, is like, in the short term, what interest rates do can be dictated by, like in 2009, rates are dropping, but the market's crashing. But eventually, when the dust settles, if rates are 0 and there's any money left, like, you're going to have to go find returns somewhere. So very low rates would incentivize people to buy stocks. I think from there, it would be like, the AI type of hype that we've seen recently, just a boom in a specific sector, and just a lot of momentum that continues. An uptrend, I guess, would be the most probably important thing. But if you could get an uptrend that was relatively stable on the back of a bunch of liquidity and low valuations, that would probably be the dream scenario. So I don't know that if that ever happens, right? So I guess if you look at the two windows where it really did work well that we know of, the best is the late 90s, because those are the books with 20, 30,000% returns or whatever. And what was happening then, just like the dot-com boom. I mean, people just, valuations were insane. I was not really in the markets yet. I was just on the cusp of entering the business then, but you can read a lot about it. And I was like alive at the time. And it was just crazy. People say stocks just go up 5% a day. And then 2020, I guess, was the next time, 2020, 21, where it really, really worked well. And what did we have then? Like coming out of COVID, the system was just flooded with liquidity. So I guess from a macro backdrop, like what kind of environment would you be looking for? I think it would be what I just described. But whether or not we ever get that in our lifetimes or ever, is questionable. It's very rare that all the stars align the right way at the right time. So I think if you sit around and wait for the perfect scenario, good luck. You might be waiting.
You'd never trade.
A long time. Right.
No, it's a good point, because it's and why I brought that up is that when you're looking at markets, it's very hard to the best idea, and I think the best traders have always done well, is figure out ways to survive those lean times, possibly make a couple bucks if you can, and really just focus on surviving at that point. For me, and if you get to the Q1 22 was great, but the rest of the year was flat, to slightly down. And my whole goal at that point was to survive. All the trends were pretty choppy. Everything that gave a buy signal gave a sell signal immediately. So it turns into survival mode. So if you can create a methodology that's into survival mode, you will be around for those massive returns. For those environments. But once again, they don't come all the time. You're sitting in 2020, 2021. There's no, it's not a coincidence that we had our best returns those years. However, 22, we had a decent return, but our goal was to survive. 23, starts to pick back up again, but it was a thin rally. So you couldn't just spin it back in 21. You could spin around with a dart, especially in futures. You could spin around with a dart in your hand and just throw it at something and probably buy it, and you probably make money. That isn't the case even today. It's getting a little better, but it's always specific areas that are working. So if you're a AI investor, let's say, and you're like hoping that, hey, in the next 10 years, I think my NVIDIA stock has another 10x in it or something. You need liquidity behind you. You need the hype behind you to stay. How do you feel today? Those stocks have come down quite a bit. Are you going to stay with that idea methodology? So you have to understand all of those things to really stick with a trade like that in the long run. So I think it's also, to your point, it's also a certain personality type that could possibly handle that type of risk, drawdown, and so on. And so that's a good question for you, because you're the guy who knows those personality types and studied those personality types. So what do you kind of find in as all your research? You have all these traders. What do you kind of find is a personality type that these people can handle these type of drawdowns? They can handle the risk and so on.
I think a lot of big success in markets. I know the answer. I just have to think of how to say this well. It comes when people are kind of young and naive. I guess we'll say this. It's very, there's old traders and bold traders and very few old bold traders, right? That's the old saying. And if you see what the legends say as they get older, they're usually like risk less. So here's a good example. Futures traders size to their stop. They don't say like, I'm going to allocate 25% of my portfolio. They say, I'm going to put on a position in my stop, and that's 25% risk. So nowadays people talk about 0.5%. And I won't go through specifics just because it'll take too long, but you go back a few years, it was 1%, then it was 3%, then it was 5%. And if you get back to like the late 70s, guys were risking 25% of their account. You can either calculate it from what you can read or people will tell you. So I guess the point is, I think that young people are more bold because they don't have the scars. They don't have the experience. If you get lucky initially, you're going to take a lot more risk. And eventually pretty much all traders end up telling you like, don't risk too much or you're going to be toast. So that's sort of an indirect answer to your question, right? It's like, look at where they end up down the road. Probably Probably not because they just kept making money indefinitely and they just, oh, you should be more careful. Personality wise, I mean, look, I think that people tend to be different. What do they say now? That he's built different, right? I think like they're different. They don't. I guess Michael Marcus is kind of a good example, and I wrote a paper on him. And in that paper, it talks that he kind of wrestled with some personal demons, and he had some sort of mental health issues, I guess is a fast way to put it. But he had this unshakable belief in himself that he would make a ton of money, and he just kept wiping out, and like he couldn't borrow money from his girlfriend anymore or his mom, and he found another way to get money, and he just kept going. And most people in life that you meet can't do that. So he's a good example of a guy who didn't get lucky out of the gate. He kind of got the opposite, but he just believed he could do it if he stuck with it. And what kind of personality type does it take? I mean, I don't think it's going to be somebody who's a government worker or interested in stability. They probably have to be pretty comfortable with volatility and really comfortable with being uncomfortable, because you're a futures trader. Like the leverage can be crazy. Like you can lose a couple percent. Here's a sort of a real-time personal example. I actually started doing this concentrated portfolio of stocks for myself because I said, man, everybody's talking about this over the past 100 years, but some people moderately practice it, but nobody actually just does 5 stocks. And so I'm like, I'm going to do it. Like I'm going to do it. And I'm going to try to make a lot of money and potentially turn it into a product. And it was up, call it 5.5% a few days ago. And now it's down 2 and change. So it's basically an 8% swing in a couple of days. And, I don't like that, of course. At least it's kind of giving back profits as opposed to like down that much from the starting line. But I know that if I want to make higher returns, that's sort of the cost of it. So I guess like I'd break it down into a couple of things, personality types. One is most people achieve that success before they know better, and they eventually tell you not to do it. 2 is there's guys like Marcus, and like whatever motivates them, born to succeed beliefs. They have such deep belief that if I just keep firing, I'll do it. And 3, I guess, I don't think I'm like Michael Marcus, but I know now that if I want to get these bigger returns, this is the cost of that. And it becomes this sort of balancing of like, well, what do I want to achieve? Of course, like all of us, like 1,000% an hour with no drawdowns, but that's not reality. So how close can I get to balancing my emotions with my goals so that I can just get as close to the line as I can? And I mean, that sounds a little crazy maybe, but I think that's sort of like the 3 camps of people that achieve these things. It's you're not knowledgeable. You just have a belief you can do it, or you kind of balance the 2. That's not to say I don't have a belief I can do it. Sorry, I'm going kind of on tangents here, but I think that,
no, I think it's good for people to hear this in real time. Like, what traders are actually going through. Like, I like to talk about that stuff because there's so much bullshit on the internet of people saying everything's great every day I have it. And yes, all of us could pull out, like especially me who has a diversified portfolio, I could pull out one trade a day and say, look how good this trade is doing every single day. I'm sure I could find one trade that's doing okay, or be like, hey, look how little this it's ridiculous. So I think you talking about what's really going on in trading is really important.
Yeah, back to the belief thing. One of the things I do believe is like anybody can study. If you got the time and you got a library card, you can learn how Richard Dennis did what he did, and Marcus did what he did, and other guys that have achieved these results. And there's methods that they use that are consistent, and they're kind of the trading principles, right? But there's also the timing. Like they didn't do well every month and every year. There were times where they just got smashed. But I personally believe that if you have the intestinal fortitude and you just say, my goal in life, Marcus style, is to just make a fortune trading, and you trade with the right amount of leverage. Unfortunately, it'd be enough that you could wipe out, but you get as close to the line as you can and hope you get a little lucky. You can do it. But, the thing is, like, let's say like him, you don't get lucky and you wipe out, and then you wipe out, and then you wipe out. then you got to go get money again. And where do you get it after a while? Do you wash cars? And it's just, the point is like, you have to keep reloading. But I think eventually, if you're consistent and you stick with it, it will work. You should probably eat your vegetables and try to live as long as you can too. But I guess the thing is, though, it becomes sort of the emotional consequence of that, right? Because people that you talk to, they're not going to be like, oh, you'll get them next time. They're going to start to say like, hey, fool, you wiped out 3 times. Go do something else with your life. So, and that's an answer that each of us has to make for ourselves. What are you trying to achieve, and how much volatility can you take? And that's, I think, where you get into the realm of like, it varies from person to person. And those guys, again, to the extent they were knowledgeable about what they did they say this is the cost of what I do? I mean, I like to think yes, but I don't know. A lot of times when you ask guys those types of questions, you don't get straight answers. So, yeah.
Yeah, no, I like that. I like this conversation because I think it's important, and I think generally, like volatility, like you said earlier, some people were at 5%, 1%. Now you hear 0.5%. You hear 25 basis points even. You hear these things all the time, and I talk to traders and I talk about 1% now, and that sounds, to the trend following community, it sounds like I'm way too over leveraged, and to retail traders, they think I'm not risking enough. So it's an interesting balance, but you have to figure out, one, like, am I managing money for other people? And if that's the case, okay, cool. What can my clients take, and what type of clients am I trying to get or attract? I know that, to get those types of returns, we need that volatility. So 1% risk for me makes sense, but also you start to act differently when you start to make money. When you have your $10,000 account, you go, oh shit, I just gotta be a little bit leveraged. I gotta do this. And then even at 100K, you start to think that. But once you hit those higher numbers, you might go, well, I kind of want to protect my ass a little bit more. And I think that's the truth of the matter when you get further down the road. But also, speaking about personality types, I working at funds over the years, the people who were really good traders, who were and I like that you said the quote about old and bold traders. There are not old and bold traders for the most part. And Jim Rogers also had a great quote where he said in a bull market, and I don't remember exactly what this is from. I was trying to find this the other day. You might know. But Jim Rogers had a quote where he talks about the fact that, in a bull market, you want to hire the youngest, dumbest kid to just basically buy everything across the board. And in a bear market, you want to hire an old man who's been through it a million times. He'll protect your money. And then the young bull trader will make you all the money in the world in the bull market. And I think that's...
Go ahead.
Go ahead.
I don't know about the bear market part, but the bull market part, he said in Street Smarts, which was a book from 10 years ago or so. Okay. He said basically what you said. So.
Yeah. So I mean, and I think that's it's very true. And I think you also understand that, like, over time, you start to make more money, you build wealth, you've taken these risks. And at a certain point, you're like, I don't want, and I think about it like myself in my bike riding career, like as a BMX pro, like you had to, if you wanted to make it to a level of professional riding, like you had to hurt yourself, basically, not on purpose, obviously, but like you had to try your best every day, get up, work hard, possibly get hurt. After you get hurt, work your ass off to come back, get back to it, and so on. Like any professional athlete will tell you that. But as the years go on, you're like, okay, I'm here, I made it. Like, I'm tired of laying on my couch every day. I'm tired of being hurt all the time. So you might feel differently, and then you might not be as good as you used to be because of those things. And it's the same thing with trading. Is like, if you're, I think I try to do this well, which is, and this is hard to do, and even for me, which is understanding the moment, understanding when I want to be a little bit more leveraged and when I don't. And I still use the Trader Vic method, which is grind your way up to some good returns. And if I feel like I'm really in tune with the market and my systems are all firing very well, I'm going to add to my leverage, go from 1% risk to maybe 2% risk, and so on. but that's only if my systems are working well because of what you said earlier, which is the environment matters. Like the environment extremely matters. If I'm in 2021, sure, I can take that type of risk. In 2022, that could have I could blow up from that type of risk. So the environment matters, and your strategy doesn't work all the time. So you have to figure out when my strategy works and how to trade. And then some people say, well, just run every strategy possible. And I don't think that fits everybody's personality type.
Yeah, I wouldn't disagree with any of that. I guess the discretionary guys talk about sizing up when you're doing well. Systems guys can build that in. It's if you do too much, you risk wipeout. So once you learn the rules, it's I guess it's sort of like, I don't know what's a good way to put it. Like there's all these parts that can be put together many different ways, and that's where the personal aspect of it comes in. You have to put them together the right way for you. Do you use leverage? How much do you risk? Do you toggle your leverage at different times? Do you base it on whether you have the supposed hot hand, or do you base it on something else? And these are all, there's no right answer to these things without the benefit of hindsight. But one interesting thing back to the kind of personality thing that I think about a lot is, so Livermore, everybody probably knows Livermore. He got really wealthy in the Great Depression and was one of the top 10 richest guys in the world at the time. And 5 years later, he was broke again. And you kind of think about that, and this goes back to the Built Different. It's like, what was he trying to do? What was he trying to accomplish? Let's say that, Jason, you somehow become like the 5th richest person in the world through trading. I mean, I hope it happens to you and you don't forget me when it does. But
great.
Yeah, but like, would you keep swinging for the fences in a way where you could wipe out? And the answer is probably not. But he did. And so something I wonder about is like, is there something different in their heads? Because clearly their goal is not just to make that money. I mean, why would you keep going? I don't know. And maybe if you ask that question, like, you'll never be one of those guys because the way they think is just different from how people with sort of more mainstream logical thought operate. But it's something I think about a lot, like what motivated him to just keep trying. And I don't know, but I think it's an interesting question because it clearly wasn't money at that point. And obviously it didn't work out well to keep trying to become number one. And then the yardstick gets farther and I got to be number one by a factor of 2 or 5 or whatever. So maybe there's some of that in the mindset of the guys that, take $5,000 to $100 million or whatever it may be.
I like that you said that, because that reminds me of, I mean, honestly, like that's a thing that I think, and what's interesting is some of those guys live very lavish lifestyles. So like, and for me, it's like, I know that the game is the most important, but being born, and that's the thing that I will always have trouble with is like, I don't really, I should probably be trying to sell more and bring more money in for the fund to do all of these things. But really for me, it's the game that's important. But also I know that growing up the way I did with, grandparents who went through the Great Depression and so on, and understanding what they went through, like I have a very frugal mindset on top of it. So, for me, it's like trading is the game, but also, and I might just be like Livermore one day and be pulling this all out to do things, but I also hide money from myself in investments outside of the market. Like Livermore talks about. So, you brought that up and I started to think about it because, I had a conversation with somebody and they were like, you kind of hide money from yourself. And I'm like, I guess I do in a sense, and it's the same thing. Like you bringing that up made me kind of bring that into Livermore because there's all the stories of him hiding money from himself. And if I ask for this money, don't give it to me and so on. It's like, that's kind of crazy to think about, but it is the mindset that kind of brings you to doing this at that crazy level. But also, for me, I guess another thing that I always have to think about is like going through like your early stages of trading and losing little bits of money. Back then it felt like everything in the world. But now it's like little bits of money. to do that today, man, that would be, detrimental. Like that, having an 80% drawdown would be detrimental to me today. But back then, it didn't matter that much. It wasn't that much money. So it's hard to do that. But thinking of Livermore wiping out, once you're at those crazy levels, that's something you don't see much. Even the other guys, like, you don't really see that much.
Yeah, I mean, Peter Brandt, I think it's in the Unknown Market Wizards, talks about how he does research, newsletters, what have you, as opposed to managing money, because he just could never get comfortable with trading 1,000 lot of bonds or 100 lot, whatever the number was. But as the dollar amounts increased, he just couldn't get comfortable with it, and that's good that he knows himself. It was Louis Bacon was talking about how Paul Tudor Jones taught him how to not think of it as money, to think of it as percentages. But it's still like a sneaking thing in the back of your mind, right? When you start out, it's like, oh, that's a stick of gum I just lost. And then it's like, that's 2 cars. And so I think that you have to sort of somehow desensitize yourself and think of it as the game for the game, more so than if I guess one thing that's consistent throughout time from studying the guys and experience and whatever is if you start to think of it in terms of mortgage payments and I could have paid off my house, it really impedes your ability to operate with the right type of process. And obviously some people can do that and others can't. And probably the best thing to do is to come to understand where you live in the divide and don't try to be something you aren't, because it probably won't end well. So, yeah, I guess that's what I would say from just all the stuff I've read and studied. I guess that still doesn't explain, if you get to some point, like what was he playing for? I don't know. I don't know. Yeah, I've heard people argue that Livermore may have been a little, I guess on the spectrum potentially. So it could be something like that. I don't know. I've never read anything specific, but when you just kind of trace back how good he was at math as a kid and his sort of innate abilities, despite being brought up in this rock farm in Massachusetts, and then what he subsequently did. And yeah, it seems like he probably wouldn't, if we could go back in time and psychoanalyze him, I imagine we'd find some personality traits that were a bit different from the norm.
My great uncle, who I learned to trade from, he was autistic, but they didn't know it back then. He was born in the late 20s, so they didn't know he was autistic back then. They didn't even have a word for it, really, for the most part. So they just thought he was slow. So thinking he was slow, they kind of kicked him out of his house. But he was just very quiet. He couldn't handle being around people very, very well. And so he started trading and he started businesses and he started all these other things. So it's kind of interesting, the conversation about a lot of, and I say this a lot because I am certainly neurodivergent. I know that. I won't go into all the details about it, but being a little bit divergent in some way, I think kind of is part of the traits I've seen in most good traders. Most good traders who like really can do it well are people like that go against the grain for the most part. Think of the Milgram experiments are a perfect example. My great uncle, you have the what's it called, when the Japanese were put in the internment camps, he disobeyed that order to do that. They're saying, hey, we got to start putting these people in internment camps. He doesn't want to do it. He ends up getting discharged because of this. So, I mean, that's a pretty big thing at the time to just go, especially back then, like to go completely away from what the government is telling you to do and what you have to do for your job, because he was part of FEMA before it was FEMA. And so doing those things, he just was kind of a different person. And I was like looking at that when I was a kid, I was always like, oh, that's just normal. That's what normal people would do because it's normal. And then now as I'm older, I'm like, that's amazing. People wouldn't do that. Like, so I think that it's that ability, because you are different, to kind of go against the grain a little bit, which is, I think, is hard to do for most people. Most people just can't go against the grain to that level. And then if you're going against the grain and you're a trader, And then you have this unstoppable confidence where you're going, hey, I know I'm right. This is going to work out at some point. Okay, I blew up for the, Michael Marcus's story. And if anybody watching hasn't read the book Market Wizards or George's work on Michael Marcus, like, you got to go through that stuff, because this guy went through blow up after blow up after blow up, and kind of being like, well, I just knew I'd figure it out. And honestly, like, that is the truth. Like, you will figure this out. Like, trading is something you will figure out over time, but do you have the staying power mentally and monetarily to do it?
Yeah, it's definitely interesting. I mean, and it's subjective too, right? Because he digs his heels in, but he's still a big believer in cutting his losses, right?
Mm-hmm.
And you talk about being contrarian, yet you're a trend follower,
Yep.
literally in the market. So and I think, like,
but contrarian is trend following. That's the one thing I've always wanted to, like, have that talk, because contrarian, like, because think about it as a trader. As a trader, everybody wants to buy low, sell high. But the second something breaks out, goes up, you want to get out of it. Even myself, I look at what my systems tell me and I go, that sucks. I don't want to do this right now. So it's kind of interesting to think about that.
Well, it's against human nature, but by definition, you're following trends. So you're not a contrarian in a way, right? And
Not a
I
contrarian
guess,
trader. No.
yeah, I guess when you kind of, and I'm not trying to give you a hard time. I guess I
No,
just
I like the back and forth. It's good.
These apparent sort of contradictions. A good thing I think about is this. So trend followers follow trends and cut losses, but they will stick with the system. So they're kind of buying and holding a system that cuts losses, but they don't cut losses on the system itself. They keep running it. They don't say, I'm throwing in the towel. And I've always thought that's sort of interesting, right? And I actually wrote a post about this, not to always go back to the meditations thing I write, but it's about faith. And, studying this stuff for years and years and years, it's like at some point it comes down to faith. And what do you have faith that will continue to work? Is it trend following? Is it mean reversion? But yeah, it's just an interesting playground, I guess, of sort of philosophical thought on trading and whatnot. But these are I don't know, you'd think like trading is math, and really it's sort of more art. And there's certainly numbers involved, but even within systems, they're really discretionary. Which one do you do? What risk levels and all these things? If you analyze it to the level that I have, sometimes you end up more confused, just because there aren't right answers. You just have to make decisions with the best information that you have.
Well, I always tell people systems are like bumper bowling. When you're trading a system and a strategy, it's kind of like you have these bumpers on your bumper bowling, and it kind of keeps you in line with doing the right thing again and again and again. That's really it. And if I think about it, that's really like the reason why I like to use them. It's not because I know it's going to be perfect. It's because I know it's within the lines. It's going to keep me from blowing up. It's going to keep me into good trades. It's going to keep me out of bad ones. And that's kind of what I think about it personally. But I do like the thought that it's like, it's an art, because it's like you kind of human brain. It's the reason why people backtest and build systems. Is like your human brain is completely, lack of a better word, insane at times, because you could create a complete methodology, a complete strategy. And I've seen it happen with systematic traders who it just makes zero sense. And you're like, hey, that's not going to work over time. But like you said, the thing that does work is finding a good method and having that faith in that method, and understanding that it will go through periods of bad periods, good periods, and so on. That's why I don't try to put anything in a box and go, okay, well, if you're a mean reversion trader, you're a bad trader. If you're a trend following trader, you're a bad trader. If you're a buy and hold trader, you're a bad, like, whatever it is, it can work, and it's going to work at different times, and it might work at a different time than me. It might outperform me at times, and I might outperform it at times. That's the way I think about it.
I think there's a guy named Bruce Babcock who wrote some books 30 years ago now. They were great. They were sort of like a predecessor to Market Wizards, guys that you knew less. But he said following the trend was a truism, and to make money in trading, you have to follow the trend. And I think it's interesting because even with mean reversionary traders, they're looking at, to some degree, the equity curve of their strategy, and they're following the trend in the equity curve of the mean reversion strategy, or they wouldn't trade it anymore. So for whatever that's worth, it's a little bit of an aside, but
No, it's true, and it's it's just I think it all works. It's just a difference in like when does it work? Because it's like trend following. If you back test it and you go, okay, it actually does have the best alpha you can get is through trend following. However, your drawdowns are going to be much more long term. You could be stuck in drawdowns for a long period of time. So then you go to a mean reversion and you go, well, I'm getting out of drawdowns quicker, but I'm not making as much money. So, these two different variations of trading really do matter in the sense of returns, but over time, it's like what is really outperforming the other. And so when I back test over time and look at that, it's there's periods where I'm looking at mean reversion. I mean, we run multiple systems, so our mean reversion systems at times will be holding up the entire portfolio, and the trend following system at other times is holding up the entire portfolio. It's just understanding the difference between that, being comfortable and like what you said, and having faith in whatever methodology you've come up with and really sticking to it.
Yeah, and a lot of that is trial and error. I mean, if you're lucky, you'll land in the right sort of division of markets when you're young at a very opportune time to be there. But I think, like in my case, I started in stock picking, long short equity, migrated to short term systematic, then macro fundamental, then various shades of quant, and sort of have evolved all of that into what I do now, although I do a few different things. But yeah, if you're lucky, you figure it all out early. If you're not, you're like me. You're a grizzled old veteran who it takes time to kind of put it all together. So,
well, I think it's everybody's journey, and that's always different for everybody. But we're heading a little bit over time, so we'll let you guys go. Thanks for joining us. We'll be back next week with George. If he has time next week, you around next week, George?
Yeah, I should be.
Okay, cool. All right, guys. We'll see you soon.
Bye.